Today, we'll examine the influence of Donald Trump's proposed protectionist policies on Canadian corporate bonds. In this presentation, we'll examine our forecasted sector-by-sector implications from infrastructure to financials and explore how these proposed Trump policies might reshape corporate spreads. Focusing on our active portfolio strategy, we aim to provide actionable insights that reflect potential risks and highlight emerging opportunities for growth. My name is Kurt Cumming, and I'm joined by Chris Curry, Portfolio Manager of the Goodwood Milford Fund and Goodwood's Institutional and Private Client Accounts. Donald Trump's proposed protectionist policies have profound implications on the U.S. and Canadian economies. Key elements include a 25% tariff on Canadian imports, tax reforms to reduce corporate taxes, penalties for offshoring, and a focus on revitalizing U.S. industries and energy production. These measures, combined with immigration reform and the potential renegotiation of NAFTA, aim to bolster U.S. growth, but could also disrupt Canadian trade, labor markets, and corporate bond levels. Our presentation will explore these impacts in detail. Today's key focus areas include projected impacts on U.S. policies on Canadian credit spreads, monetary policy, and foreign exchange, and how these will influence Goodwood's fixed income mandates. Chris, how does Trump's election win present opportunities and challenges for the Canadian corporate bonds?
Thanks, Kurt. Of the 12 sectors we analyzed, there's different impacts on each sector. So before we go into that, though, I do want to have just a quick review of investment-grade corporate bonds. And the key mechanism by which investment-grade corporate bonds are priced is what we call the spread. So we're going to talk a lot about, in this presentation, spreads widening, spreads tightening. So spreads widening means that investment-grade corporate bonds, similar term to a government bond, they're going to trade in the same direction, up and down. The difference in the price is going to be related to the credit value, and that's going to be determined by what's called a spread. So if spreads are widening, that means that potential values of corporate bonds are going down. If spreads are tightening, they're getting closer to the government yields. That means that prices are going up. So just give you a quick review of what we're going to spend a lot of time talking about. So if we jump right into the auto sector, in the news every day. I mean, this policy has a number of people stumped because the amount of trade that goes back and forth between the Canada-U.S. border is really mind-boggling. So, why he would target the auto industry is sort of beyond a lot of people's comprehension. But this and the energy industry on the next page, similar situation. Very, very large export of Canada. 30% of Canada's exports are oil and gas. How the U.S. can stop the flow via pipelines of oil and gas that are necessary to feed the refineries that drive the industry in the U.S. Again, we're stumped on that. I would point out right here that the market has not responded to these tariffs at all. The spreads have not widened at all. There have been new issues in these sectors, so the market is definitely in a wait and see mode. The other area that we found had potential negative impact was the retail area, and reason for that is retail is heavily dependent on imports, whether from Mexico, food going to the grocery stores, components of products that are sold on the retail shelves. Just think of Canadian Tire, all the products made in China. So I think the retail sector is one that's going to see, potentially a large impact, but it's not on the magnitude of autos and energy. But moving on, of the 12 sectors that we analyzed, 4 of them we think will have no changes in the spreads that from the tariffs, no impact on the spread and on the pricing. So those would be infrastructure, real estate, telecommunications, and utilities, and they all have the similar theme, that is heavily concentrated in Canadian domiciled assets. So if there's no product crossing the border, not going to attract a tariff, The only impact could be if these companies use Mexican or Chinese products in their manufacturing process or their process of cost of goods. That may have an impact, but we didn't see that as hugely significant. So let's move on to the sectors that we see positive benefits, actually, where spreads could widen, corporate bond prices could rise. So we have five of those sectors. Biggest one, and also the biggest issuer of corporate bonds in Canada, is the financial sector. So this would encompass all the big six banks, credit unions, credit societies, investment managers, insurance companies. A number of these companies have operations in the U.S. They're U.S. domiciled, they're U.S. incorporated. So we think that there could be a big benefit if Trump reduces the regulatory burden on those entities. They could see increased profits. Also, directly, if he cuts U.S. corporate taxes, that's going to improve the bottom line of these credits. So, financials could be quite a big beneficiary of this. Other sectors that benefit, you can be the high yield bond group and the Canadian dollar maples. I mean, Canadian dollar maples, these are U.S. companies that have come to Canada to issue Canadian dollars. U.S. companies, big benefit from policy reducing regulatory burden and also cutting taxes. High yield bonds, similar to other positive sectors with U.S. with U.S. operations, they're going to see the benefit of lower U.S. corporate taxes. Independent power producers on the next page, similar story here. A lot of them have bought U.S. Utilities, and they're going to benefit tremendously. And lastly, industrials. Again, same story. Big U.S. subsidiaries, and could see a positive benefit. So overall, of the 12 sectors, Kurt, that we looked at, only 3 negative, 4 we see as unchanged, and 5 we could actually see a positive benefit in spreads. So spreads could tighten, and their prices would rise. So we at Goodwood we publish reports after every Bank of Canada and after every FOMC meeting, and we also publish our forecasts for interest rates. And we note that we have the Bank of Canada is going to cut down to sort of a terminal rate of 275. The U.S. we think is going to hit a terminal rate of 375. So U.S. rates are going to remain above Canadian rates, and that has a significant impact for the Canadian dollar. Canadian dollar is already weak. Is already weakened, and we think it'll weaken even more if the tariffs come into play, especially on the auto and the energy sector. I mean, that's very problematic for the Canadian economy. So, in our portfolio management process, where we see an opportunity or a need, we do have the ability to hedge the Canadian dollar. So we buy securities where we can negate the impact of the U.S. dollar rising against the Canadian dollar. That's typically buying U.S. dollar assets. So a portion of our portfolio is denominated in U.S. dollars, so that it works as a natural hedge against the fall in the Canadian dollar. And then lastly, I just want to summarize what we've talked about. So in terms of the market response, we have not yet seen any change in spreads from the dealers, the traders. The new issues market continues to be very active in the investment grade corporate sector. I note since Trump's tariff announcement, there have been 2 large oil and gas operators, Husky Midstream and Wolf Midstream Canada, both issued $400 million issues, very well received and trading at a premium. So reasons for that is, we think that the market and a number of investors are viewing these, the Trump pronouncements vis-a-vis tariffs as, posturing, bluster. The rating agencies have not yet acted. That's important because that's a big driver of bond prices. And so we think that in conclusion, the tariff proposals in regard to the investment grade, Canadian investment grade bond market really could have a negative impact on 3 of 11 sectors. Two of those sectors, we just don't see coming to pass because it's just so draconian. We think it could potentially cause a North American recession. The Canadian dollar really is taking the brunt of any negative sentiment, and that's fallen. But we do have the natural hedge there. So I'm going to pass it back to Kurt to talk about returns.
Thanks, Chris. So this is the Goodwood Funds. It's a credit-focused mandate. They invest in opportunities with the best reward for the respective capital structure risk. Since 2006, the fund has won multiple awards for its returns and risk-adjusted returns, outperforming passively managed ETFs over the short, medium, and long term. The fund is offered through major bank-owned and independent dealers across Canada or directly through Goodwood Inc. With comparatively low turnover ratio, our investment approach excels with dynamic, active management, adopting to macroeconomic changes while leveraging Chris's over 30 years of fixed income expertise in the Canadian corporate bond market. With a strong focus and a history of maximizing returns through higher coupon income and credit enhancing events, it's earned 11 industry awards, including Best 5-Year Sharpe Ratio and Best Canadian Hedge Fund with a 10-year record. The strategy delivers outperformance and low volatility with superior diversification through a balanced mix of income-producing securities. Our client-centered approach emphasizes compliance, oversight, and most importantly, alignment. So as Chris mentioned, we do publish different not research, but commentaries on what we're doing in the portfolio. After every Bank of Canada and FOMC announcement, we do put out our commentary of how we're reacting to that in our portfolios. We also do a very in-depth analysis on a quarterly basis where we provide return attribution. Of course, we provide the monthly commentaries, and we do these ad hoc webinars whenever we think there's something important that we should let our clients, advisors, and consultants know about. So if you're not already receiving some of these publications, please do reach out to myself, Chris, or Sarah Van Aken, and we'd be happy to put you on the distribution going forward. Thanks for your time today, and I look forward to talking to you soon.